Tushar Mahajan, Head of Derivatives with Nomura, joins us. Tushar, good morning. Thank you for joining us. Tushar, for a long trader, this is a horrible market, but for a short trader, this is a great market, and this is the best market I've seen after 2008.
Pretty much. I think the kind of velocity that we've seen in this fall, it's completely baffled, and everyone who's traded on the short side, he's kind of laughing his way back to the banks right now, given the fact that there's been such a huge correction of almost like 6% in 2 trading sessions, and 6% on an index means substantial cuts on individual stocks per se. We were looking before we opened the session on Friday, it seemed like finally we will break down on the list of negative weekly closes that we've been seeing over the last 3 or 4 past weeks. But unfortunately, that wasn't the case to be on Friday also, given the steep cut that we saw erasing all of the early week gains. And I think today as we open and as we trade, again, there is no respite, and it's a really bad indicator with respect to, what the overall market sentiment is and where the markets could be headed to.
So Tushar, I mean, what is the next support really for the markets? We're already on the brink of breaking 5,400 as well when it comes to the Nifty.
We were looking at the first supports to come around the 54, 50 odd levels, which was basically the gap of opening which the markets saw last year, September, when the government announced the first set of reform measures in September. But that seems to have been taken out in a jiffy, and now, any support is really just a support number to talk about. We could look at some kind of level support coming in around the 52, 50 odd levels, but mind you, that's again 150 points knocked down from here. So, between that, you could really see the markets kind of crack down to those levels, given the way we've been seeing the sentiment in the market.
Tushar, would the stark underperformance for the bank Nifty and all of the banking constituents continue for some more time to come till the Nifty, bottoms out in the near term?
I've always maintained that for these markets, Bank Nifty tends to act as the lead indicator. I remember having spoken earlier about the fact that, when we were talking about the 13,000 levels on the Bank Nifty, it was important for it to sustain above those levels for the markets also to have, reached their all-time highs. It never did that. It cracked all the way down from that, almost 9,200 right now. And there is no respite. So given the nature of the Bank Nifty, which tends to act as a leading indicator, it's very clear that unless that route stops, you don't see the pressure on the Nifty easing off. And for the moment, it looks like, the Bank Nifty continues its travels.
Do you have a price target for the Bank Nifty, or the Bank Nifty is open trade right now?
It's an open trade really, because there's so many factors that play on the banking space per se. We were talking about private banks being better off than the public sector banks, but they've joined the crash, equally well with this similar kind of velocity over the last a few trading sessions. Then there's been talk about, all-weather stocks like HDFC Bank. Even those haven't been spared. So, at this point in time to say that these are the price targets for Bank Nifty, that would probably be a tough call to make.
We've already cracked below the 9,200 mark on the Bank Nifty. Let's just see names which are actually holding out in trade right now. While the Nifty is staring down by about 65 points, Tata Power, Kane, Ranbaxy, Dr. Reddy's, and to some extent, IT is the resilient one. Tushar, it clearly seems that investors have been hiding in just 20% of the market cover. IT, select pharma, select FMCG. Do you think this dichotomy would continue, or it's just a matter of time when these sectors as well fall hard?
I think the reason for IT and the pharma space is really the export-driven nature. We are seeing what's happening in the currency market as well, with the INR behaving where it is. And, the first benefits of a weak currency ends up going to the exporters. And, that's where we are seeing the IT sector and the pharma sectors kind of holding up. Consumers being a relative stronghold over the last, few years, I would say. We've seen one bout of correction in some of the large cap names first on, but with HLL holding on to the 600 odd level, ITC holding on to the 320, 325 odd level, I think we will see people continue to hold on to these names, as they shift out of some of these other names, especially the banks. But, between the three sectors that you mentioned, pharma, IT and consumers, if I have to say that, which could be the next one to crack, consumers probably would be the next one to crack. But I think IT and pharma might continue to provide some support to the market.
Tushar, at a time when we are in a very strong, pronounced downtrend and institutional activity is no longer a tailwind, in fact, institutional selling is now a headwind, is there need to sit on long positions? I mean, capital preservation is great, but, the best trade here could be either get out or go short.
Which is, kind of what we are seeing in the markets as well. The volumes for the kind of crash that we saw on Friday weren't really too great. Institutional participation overall, in terms of just volume numbers wasn't too great, which clearly means that, people are beginning to hold out and get tired of this market. And remember, for the foreign institutions, the headwinds on the currency are massive, with the kind of move that we've seen in the currency, all your, so to say, notional capital gains that you might have made, they get wiped out in dollar terms. So, what you're saying with respect to, just stay out and hold the market, just stay out, I think that's what is happening. Else, what we've seen is that people have, kind of built very aggressive positions on puts. If you look at on Friday's numbers, I think the open interest for put buying by, foreigners, that's gone up by almost 120,000 contracts. That's quite unprecedented. It clearly means that people are, looking to, let's say, pay up a little bit extra and buy that extra bit of protection for their portfolios till the time they're able to, really get out. But to say that, people want to be just long India, that definitely doesn't seem to be the trade that's working.
In the near term, Tushar, at what level do you see the index on expiry day?
That's 10 days and it's a long time in, times like this. But hopefully, I hope that, we don't break well below that 5,400 odd level. And, if we do, I don't think that we are breaking that 5,250. But 5,400 for now is what I would probably, look at the index to hold. I know it's a bold call for the next 10 days given the kind of velocity that we've seen. But, at some point, you'll also see valuation principles coming into play.
Tushar, I was just looking at the FI positions in the F&O market and they are some kind of a record high when it comes to the short exposure. So once the market reverses, do you think short covering really could fuel a lot of momentum?
Well, short covering definitely, for after falls like this is definitely, it is always an opportunity, possibility for the markets to see a big move. That's what everyone would be hoping for. But frankly, Nikunj, the fact of the matter is that beyond the Nifty, you're also seeing massive headwinds coming in terms of, the other two macro variables, which is the government yields and the currency. So, your macro trends have to improve before, people really come in and plug that big positive button to cover their shorts. I don't think people are going to be in too much of a rush to cover their positions. That's always a possibility after this kind of a fall, but doesn't look like, other variables are pointing to that anytime soon.
Okay, Tushar, appreciate your time and thank you for joining us.